Good morning! This is the Abundance Mindset Podcast. Sit back and relax as we discuss hot topics on how to handle and grow your business, self-development, and how positivity can bring profitability in your life. Here are your hosts, Vinney and Gualter.
Welcome back, Alchemists. This is Abundance Thursdays with myself, Gualter, Amarelo, and the great Vinney, Chopra. Vinney, how is everything going in California? I noticed you're not walking, but you are outside.
Yes, I'm sitting down in the gazebo here. No, it's cold. It's 50 degrees, but very nice. It's not too cold at all. I just enjoy that. Christmas yesterday was amazing. Neil and Monica are home for a few days. They live nearby. Neil lives only 30 minutes away. Monica lives 1 hour in San Francisco. But we were invited by our very close friends. We have known them for 44 years. I've been married 44 years. So 1980, when we moved to California, that's when we got to know them, and we are lovely, great friends, and seeing the kids grow together and everything. So it was fun. It was fun last night. Tonight we are inviting them. Then tomorrow we have family coming.
So this is a time of the year where a lot of people are...
Relax. You gotta just...
Sorry, a lot of people are setting goals now. So New Year's Eve is here. In fact, I went to the gym this morning, and I noticed the gym had a lot more people than it did before Christmas. So some people are already New Year's resolutioners saying, I'm going to get a little head start and getting in. Yep. I've been getting a lot of people texting me from the mastermind, from Alchemist Nation, accredited investors saying, hey, what should I do to set goals this year? What was that thing you did the other day about goal setting? And one person whose birthday was today, actually, Richie Decker, he texted me and said, hey, man, what's the book I should read for my birthday so I can set better goals? So I know goal setting is big on people's minds. But today's principle is, or the one we're going to talk about this Saturday, is increase your income through increments and surges. It comes at a perfect time to do goal setting. We just came off from spending a lot of time with family. You're still going to spend more time with friends and family tonight. Yeah. So increments and surges. This is something that Grant Cardone popularized, the idea of increasing your income through increments and surges. If we could find out from you, Vinney, who has done this in 30 different businesses, multiple different sectors, and it seems like everything you touch, even if there are temporary losses, like the stock market affects all of us right now, but even if there's temporary losses, you always seem to be a winner. You pick winning stocks, you pick winning businesses, you pick winning investments, real estate, you pick winning buildings, and your buildings, everything you and I have ever talked about, it's not just, you never invest just for the big cash out at the end, the big surge. You also always find a way to get these little increments. So this is, I think, probably one of the best people, you are one of the best people to talk to about increments and surge, especially with your investment style, which always is very close to Warren Buffett, where you always include cash flow. It's all, every business you acquire or thing you do always has to have some sort of cash flow to it. So Vinney, why is that? Why are increments and surges so important?
Kind of you, very good, brother. And this year, 2024, we sold 2 assets. One over there in Tennessee, bought for $12.5 million 2.5 years back, and value added it. It was giving cash flow, but then the interest rate went up and everything. So we were able to appraise it at $17.3 million. So we sold it this year. That's a good chunk, $5 million profit for the investors. 70% went to them, 30% came to us. Then we just sold Princeton Park, also another asset in Florida. We were really happy. We bought it in COVID, actually, just before COVID, to be truthful. And that was 2019, December. And we sold that this year also. And we won the case with our Austin deal. We have $4 million in the escrow, non-refundable. So that was very exciting. You're right. The key thing is everybody, we should diversify. I always say that. Do a little bit here, a little bit there, a little bit here. Put some in startups, put in stocks, mutual funds. A lot of things are happening, but real estate is something you got to keep money in real estate because it's the leverage game. See, most of the other investments, you have to pay 100% to own them. But in real estate, the bank comes along, or the institution, or Fannie or Freddie comes along, they give you 70% of the loan, or let's say 65% of the loan with the LTV, and you bring 35%, but you are actually controlling the whole 100%. When you sell it, we got to look at the real estate which is cash flowing. As you and I were talking before we started recording, people call me and they say, Vinney, should I buy this? The cap rate is 3.2, or cap rate is 4.5, or cap rate is 6.5 or 12. I just say, what's the cash flow? The net cash flow after getting all the revenues and all the expenses, you come with the net operating income minus the capex and minus the mortgage payment and so forth, is the net income. So net income, net cash flow is king. We should
so
be.
You're getting at a point, because I want to make sure everybody who's listening is grasping what this is. Cap rates are a function of identifying how much your property is worth. So
yes.
For any investors not familiar with cap rates, you take the NOI and you divide that by the purchase price, or you could take the NOI and divide that by a cap rate, and it gives you an ideal purchase price depending upon your investment strategy. What I've heard is you buy it at 10, sell it at 6, so you have this big arbitrage of profit in between. That was, I believe, Dave Lindahl says it, and there's other people who said that over the years. So for what Vinney's saying right now is the increments of income are far more important than the surges. But if you get good increments, if you buy the property for cash flow and then you do your value add and you do all your improvements, the surges are inevitable. They're an inevitable component to it. Vinney, you wouldn't invest in something that wouldn't offer a surge, right? You wouldn't invest in something that there was no value add, that there was no opportunity to increase. Can we talk about that for a moment?
Won't touch it. Will not touch it, brother. Because the key thing is, when we are pulling money together of the like-minded people, what I do, right? These are the people who really want, they don't have time or energy, but they have money, accredited investors. They want to, like-minded people, when they join hands, you're able to pool the money together legally, and then you can buy larger assets. Like 12.5 million assets in Tennessee that we bought, we were able to raise money. We call it raising money, collecting everybody's money, and then they become limited partners in the deal. And now we were able to make $5 million profit in that. So they kept 30%. So their investment grew almost 100% in just 2.5 years. Their investment grew 121% in this case.
Wow. So and it's not all cases. So for everybody listening, we're not selling any stocks. We're not selling investments.
Nothing.
This is not financial advice. We're just talking about a deal that Vinney has accomplished. So we're not raising capital on this deal. It's a done, completed deal.
Done deal. Totally. But the value add function was the real reason we bought it. We knew that it was 100% occupied and the rents were low by $600. What?
Per unit.
This flipper had done a lot of good renovation, almost 2.6 million. She put it into it. And when we purchased it for 12.5 million, I said, oh my gosh, 12.5 million minus 2.6, my cost basis is only 10 million something, and not the headache of 2 years of renovating every unit.
So this was a lease up play. So she actually went and did the renovations, but she forgot the rest of the value add.
She did not, because she was a flipper. She was not a multifamily owner, and she just didn't know. She was out of town, everything, whatever. But the key thing was that she just wanted to sell because she had bought at the auction and did the renovations. She was going to make great money at 12.5, and she got her cut. She made it really good. But then I came in with my team, and we knew if we get the third party really good one, and RAM Partners, thank you so much. What a beautiful. And also our community manager, she handled everything. For 107 units, it's small for us, but we took it. But the key thing was the community manager was amazing leaser. She was just like, when we knew that this property, we have to change the demographics 100%, because we wanted to implement the RUB system. That's the ratio utilities bill back system, so that people pay for water, trash, gas, electricity they were paying. But then we also needed to increase the rents. And when the leases came due, then only we could increase by bumping it by 200, 300. It took us a year and a half, and we changed 100% of the demographics and increased the rents by doubling, almost doubling it,
So this
literally.
was a heavy lease up. This is not, you're making it sound easy, Vinny, but what you did is you took 100% of the tenants and slowly shifted them out of the
Shifted them.
building,
Yep.
leased up with new tenants, implemented RUBs, which is where you bill back the electricity, the gas, the heat, the water. So you
Yep.
took maybe even a C-class property where all of that was included before, right? No
It was
utilities were
like,
split,
it was C plus, let's say, or B minus, because it was renovated and they had
but the
added some
utilities
new
were all
building.
included, correct?
Utilities were just the electricity they were paying, because it's billed back, it's individually metered. So electricity, but water, trash, gas, termite, everything was paid by the seller. Hold on. Cable was paid by the seller, and the cable TV and also the internet, everything was paid by the seller. So that was my number one thing, to cancel that and then get that all on the back of. And people are living in their home, they have to pay for the cable, they have to pay for all these things. So every community I bought in last 18, 19 years, that has been my strategy, to really look at the value add. Where can I cut expenses and increase income? Other income, it's called other income, because through the parking lot fees, through covered parking, through valet trash, sorry, not value, but valet trash, which is like amazing. When the trash can is so far away from the unit, you just come Tuesday mornings and Thursday mornings, the maintenance people just pick up in white bag, plastic bag, their trash. And the residents pay $25 per month for that service. They love it. They never have to carry the trash to the trash can. Maintenance people do it, and you can make a lot of money, extra income. Same thing is true with the bill back system, because with the quality of people you have, you let them take care of their water, trash, gas, electric, all that, and the termite also. Legally, you could bill for termite also. The key thing is, once they start paying water charges, the bills go down, because they are not taking those massage showers. They are not really doing the laundry in their home, in their apartment, and doing it for few clothes. They're not keeping the lights on all night long, or air conditioning, brother. I find the behaviors change of the residents. And then the owner, us, realize the benefits of it, because the revenue now is rent, increase in other income, and then you reduce the expenses by cutting out the cables and this and that, and cutting out what other expenses in insurance, better insurance, of course, that's a big one, and also contesting the taxes on the property is a big one. A lot of people forget about that. And then you
Vinny,
really, yeah, go ahead. Yes,
I
yes.
feel like I'm getting a master class right now, which is the perfect time. We're about to buy 80 units in Jackson, Mississippi. That
Hmm.
47 units are vacant. So to go and
Hmm.
implement RUBs right away
Yep.
is so easy because the
So
new tenants
easy.
aren't going to know anything different. We
Hmm.
do need to change the whole demographic. I need to do exactly what you just
Yes,
did.
yes, yes. We should do it. We should do it together, brother. I'll be on the sideline and let's record and everything, make a case study out of it. I think that'll be fantastic. The beauty is that how we did the whole demographic change, we kept our occupancy never less than 90%. Never less than 90. So it was 99. 90 to 99 was our range. And we said we'll never go down because we don't want it to be unstable asset, because 90 plus is stable, and less than that, like about 70, or like 80, 87, 86, 85, 80 is unstable. And it was what kind of loan was it? I'm trying to remember now, whatever it was. But the thing was, by doing these extra things, our mortgage went up from, I think, 28,000 when we bought it to 72,000, because the interest rate was a variable interest rate. Oh my gosh. Oh my gosh. That was a big stressful situation. But then I made a decision to refi it, going from like 3.71, it went to 7.5, 7.96, I think. And I got it at 5.6 refi or something with a 10-year fixed. That's what really increased the value of that property also, because the buyer, when I sold it this year, they they assumed the loan,
They assume the loan.
they assumed the loan,
Such a good loan.
and
Yep.
it was just a 9 years more left at 5.61, I think, percent, and everybody came out as winner.
That's a winning situation. So you just gave everybody on the call a value add strategy to help increase income. That's surges, right? That's a big surge, is
Yeah.
by being able to sell a valuable loan to the next investor.
Yes.
If you can get that down, that must have been agency debt. That was a Freddie Mac or a Fannie Mae.
It was agency. It was agency debt, and it worked out really well, because I think, again, thanks to my brother Mark Krupina, he and I discussed and talked, and I said, "You brother, this is going out of the roof here. All my cash flow is going to the mortgage. 72,000, from 28,000 a month to 72,000, and still." We increased that cash flow through doing all these value add and everything. We didn't have to put a dime from our own pocket. So that was amazing, what happened. Similarly, the key thing is, in real estate, we look for cash flow, monthly cash flow, and the big surge comes when the equity gain, when we refi it, we call it waterfall, or we sell it. So refi or selling is where you get lots of dead equity that has increased. Take it out and give it to the investors to reinvest again that money. And then otherwise, you could even do paying back, or if it's in a fund, you could buy another property, because the money should be moving. I call it velocity of money, and that happens, especially when like-minded people, they invest with you for 3 to 5 years. You want to exit it also at a good place so that they can take that money and run with it or reinvest with you, which is the case in my deals and all that.
Hi friends, this is Vinney Chopra from here in Danville, California. And you might be saying, hey Vinney, what are these over here? I wrote this book a few years back. Apartment syndication made easy. It became top seller. I came from India with $7 in my pocket. It says 500 million. It's going to be 1 billion very soon, very soon. I'm right at about 850, 900 million. And then I'm ready for the next billion. Actually, you will see that happening, 2 billion in this book also. The other book I wrote, which has been a very big positivity, has been my life. Always, I've been married 43 years with 2 children, and the beauty is to be positive, the mindset that can take you to all the places in the world. And that's the book that also became big seller. My third book, Senior Assisted Living, is coming. So do yourself a favor, go ahead and click the link below to get free copies, audio copies of these books, even printed copies of these books. Printed means digital if you can't afford it, but I would highly recommend for you to get these, or go to Amazon.com. Just go to Amazon. I got it in soft cover, in hardcover, in Kindle, in audio, also the Spanish version of this book also. So let's crush it, guys. I know you can be successful. I know you can do the kind of things that you want to do in life and have the streams of income and know how to really educate yourself so that you could become a strong force in this world in real estate. I know you can. So take that step. Don't just be on the sideline. Take charge of your life. Take charge of your education.
And that brings two things. One, so sometimes Vinney will say the word dead equity, and sometimes my ear hears debt equity. So I want everybody who's listening to understand Vinney said dead equity. You want to move dead equity because of the rule of velocity of money. So you don't want money just sitting there. That'd be considered dead equity. It's not growing. It's not expanding. It's still getting cash flow, but the cash flow is going down based on return on equity because the property's value keeps going up. The cash flow remains about the same, even with all the benefits that you'll do with expenses and rubs and saving money and increasing rents. The cash flow per equity doesn't always seem to keep up because equity sometimes in markets like this just keeps growing. The other thing that Vinney's talking about is combining funds. We were talking about this before the call, and I want to express how important it is to do bigger deals. There's better money, there's better cash flow, there's less risk. Believe it or not, there is less risk on a larger deal than there is on a smaller deal, because a smaller deal doesn't always have the money or the funds or even the team or the investors to go and make changes. So the more you expand the size of deal you do, as long as it's within your capacity or within your team's capacity, and you do it with sophisticated investors or credit investors, people who've done things like this, you have this pool of funds and this pool of knowledge, and you have this pool of connections. So you get a lot of extra benefits from doing these combined deals. When I started Vinney, I did not like to do deals with other people. I was very aware of cash flow. I knew that was important. So increments are important. I know that. And I knew that appreciation would be possibly important one day. I was like, but I was always trained with cash flow. It doesn't really matter if it appreciates. But listening to you today, and over the years, I've learned the surges are so important. You can actually manage for them. You can predict them almost through very good, strong management. So increments and surges actually become really important. And as I've been exposed to them and as I listen to your stories, you don't invest alone on your really good deals. It seems like your really good deals, you're investing with other people. That's why they've been so good.
It's so amazing. It really, I would be standing still. I'm telling you, 18 years back, I learned the ideas and the techniques and the know how to talk to investors, family, friends, and show them my excitement and enthusiasm when I had underwritten a good deal. I said, let me share with them and see if they like it. And they liked it. And they said, Vinney, oh my gosh. So you're going to move to Texas? You're going to do this, that? I said, no, I'm not. I'm going to be living right here in the Bay Area, but we'll be able to have teams of people there who will be managing them. You will not be managing. So our limited partners don't do anything. They are not on the loan. They are not at any risk, but just their investment of 50,000 or 100,000. That's the most they can lose, right? But they've never lost. That's the best part about it. Because once you underwritten, you really and you get a good loan, good debt. I would like to say good debt and bad debt right now. Not debt is good if you're investing or the loan is on an asset that is going to bring cash flow and big surges in equity gain, then it's a good debt. The bad debt is when you buy assets like cars and aeroplanes or this and that, and they depreciate. So when they depreciate and you're not able to make any cash flow out of it, that's a bad debt. You have to live in a good place and provide to your family and other things like that. So I believe in that. You just don't want to just keep on making money for what? We'll all have to go upstairs. So in heaven. So let's just enjoy what we make and work harder. And that's what has really helped me a lot to be a servant of the investors. And once you are very loyal and very transparent, and you really keep everything very up SEC rules, Securities and Exchange Commission rules and regulations are followed, then you are in a good hands.
What Vinny's saying right now is if you're going to be doing any kind of investing, do your deals morally, ethically, legally, follow the rules. The rules are the rules because they are the rules. They don't try to break rules, right? Don't try to beat around the bush or adjust. Just follow the rules. Now, not all rules are real rules. So you do have to learn what are real rules and what are, fake, made up. So many people have rules around don't talk to strangers, right? That's not a real rule. So all of
No,
my best friends were strangers at one point. My
totally.
great mentor was
Mine
a
too.
stranger at some point, right? So there's some
Totally.
rules that aren't, they're fake rules.
Yeah.
Um, but doing things legally, morally, ethically, that's really going to be important for your investment strategy. So before we wrap up with increments and surges, you did bring up debt, and you brought up bad debt, and you brought up good debt. And I've been becoming more and more aware as there are different loan products that don't always work for certain deals. So
Mhm.
we couldn't call it bad debt, but we would have to say it's wrong debt. So there could be, like I would say for some of the deals that I've done, 12% interest would not be a good loan. For
Ah,
a hard money loan would not be a good loan for a multifamily investment long-term strategy. But there sometimes, right, on a flip, yes, hard money can be a great opportunity. And then there are some loans, like bridge loans, are not great for long-term stabilization. There are certain financing strategies that are not appropriate for certain investment strategies. And there is
y-
you have to
you
take the time and place to learn those.
you hit the nail on the head, brother. Oh my gosh. Hard money loans are like the flipping loans, like you just said, flippers. They get 12%, 14%. So hard to predict the market. And the key thing is what really got a lot of people in trouble in the last 3 years has been that because able to get that 80% loan, low LTV, because it's a 20% down, 80% loan, hard money loan, and they were able to value add and
I think we just
after the
lost.
whole rehab, right? After the which was the interest rates kept on going up in 23. And now we are going down, right, a little bit in 24. You're so right. Just an example, if I may say, residential assisted living. I bought these two homes. I paid quarter of million down or whatever I did. And then hard money loan, I got it at 11% within 1 hour. But then I refinanced within 3 months. So I paid back no prepayment penalty. So it was a calculated risk of paying them a little bit more because the seller was antsy to sell it quickly in 3 weeks. And I was able to do that. And now I got the loans for 5.75 fixed for 30 years, and then another one for 6.25 or something. So it's good to really do some good education on it and be in touch with lenders. That's what I would say. Have a
This
business plan and then apply that business plan. Yeah.
So this is very important for investors who are acquiring real estate, who are underwriting deals. If you're passively investing and you're underwriting deals, look at the terms on the mortgages. Look at those rates to
Yeah.
make sure that the investor is going into something that actually will cash flow. There's a lot of
Totally.
investors who've gone to syndication courses, great teachers, by the way, great teachers,
Hmm.
great syndication educators, but they didn't
Hmm.
catch everything.
Yeah.
But they learned how to raise capital. They learned how to lock something under agreements. I love that people are learning. I love that people are investing in real estate. I do love that people are syndicating and bringing combining people's money together. But
Totally.
as an operator myself and as somebody who passively invests, be paying attention to the loan, the debt, be paying attention to the underwriting, pay attention to how much they think they're going to reposition the property, how much they think they're
Yes.
going to go up in rents, and what their
Assumptions.
strategy is.
Ooh,
Underwriting right now, Vinny, I think is
crucial.
more important
Crucial.
than it has been in the past. As a passive investor, I think it's becoming more and more important.
I totally agree with you, brother. And the template that I put together and Alchemist Nation uses is anybody watching us. If you would like to get that template, just DM Brother
Yeah.
Gualter or myself. We'll love to give it to you because you can really do wonders. I have a quick calculator now, even better one, and then also the detailed one for 5 year projection, 10-year projections, and so forth. So we would love to. And goal setting. I know we started this whole conversation with 2025 upon us. We have a 4 page, I think, fill in the blanks goal setting worksheets also. If you would like to get those, I will be sending them to you, Walter, so we can share that with the Alchemist Nation also.
Thank you so much, Vinney. And for each of you who has committed to increasing your income, increasing your net worth, taking care of your community, taking care of your family, cheers to your success. We do this every Thursday.
Yes.
Most of the time. It's Abundance Thursday, 9 a.m. PST, 12 p.m. EST. Merry Christmas to you, your family. Happy New Year, and we'll see you in 2025. Cheers to your success, your choice. Always work with the best. We'll see you next week.
Yes. Enjoy your special time with your loved ones. Thank you, brothers.
Hey there! The upcoming episode is scheduled for Thursday. We appreciate your viewership of the Abundance Mindset Show. Tune in every Thursday at 9 a.m. Pacific Standard Time or 12 p.m. Eastern on various social media platforms hosted by Vinney Chopra and Gualter Amarelo. Don't forget to subscribe, share your comments, and leave a 5-star review. Thank you for your support.